Wealthy and Wise is your guide to value investing, powered by Team Invest.
Hi there, welcome to Wealthy and Wise. Lovely to be here with you when we go offshore and stock specific this week. And this time it's all about US value. For years, US markets have been treated like the growth engine of the world. But with mega cap tech stretched, private market excess creeping into public valuations, and a growing chorus of bubble warnings, the question for value investors is getting sharper. Is the US still the safest place to grow capital or the most dangerous place to misprice risk? We'll add some value on that front and go head to head with specific stocks as well. Plus, of course, we'll answer a viewer question. So let's get to it. Let's add some value. I know, everybody wants to get to the stocks, but first, let's unpack the growing tension between fundamentals and, call it narrative, including warnings from global institutions that parts of the market are showing late cycle behavior. High-profile capital raises, SpaceX comes to mind. So is this a classic signal of froth building in risk assets? Are we in a bubble? So welcome to my guests, Andrew Coleman from Team Invest, and joining us this week as well is Kai Chen from MPC Markets. Great to have you both here. So, where to start? Are US valuations justified by productivity and AI-led growth?
US, no. Individual companies, potentially, yes. But I think that's the case the same with the Australian market. You know, as a value investor, someone who looks at the fundamentals of the company, the question should never be, is a market valued or not? Or is an asset class valued or not? Because you very rarely, unless you really are just owning an ETF, you're not owning an asset class. You're owning companies or items within that asset class. So I think the US market has got the same kind of symptoms that Australia has, a bifurcated, the US they call it a K-shaped differential. You have some companies in the US that are growing rapidly, that's sucking all the oxygen out of everyone else, and everyone else is, flat or backwards. And as a result, the overall market, when market cap weighted, looks like it's rising, but it's not rising equally across the board. This is not a rising tide lifting all boats. This is a few companies growing at rapid rates, supporting anemic returns from the rest. And you see that in the US economic data. I mean, the US economy is not growing particularly fast. It's certainly not growing at the rates that would be required to justify the hype around the productivity gains we will hopefully get one day from AI. Whether that will happen or not, but I mean, hopefully the goal is to get all this productivity gain. That's not being seen in the economic underlying data. What we see is a few companies benefiting by being able to sell lots and lots of product at higher and higher margins. Now, the economic historian in me says, I probably agree with those experts, that's the late stage of a bubble, but that's not to say the technology isn't unprecedented or won't do wonderful things. It's just, that's the problem of fundamentals which are, knowable about the past and unknowable about the future, colliding with emotions which seesaw up and down.
Economic historian, add that to the list. Kai, first of all, take a step back. We talk through a value lens on this program, as I'm sure you know. How would you describe yourselves at MPC Markets?
Yeah, for me personally, I'm a tech enthusiast, and I actually enjoy the AI thematic quite a lot because we use it quite a bit. I do see the real world applications of AI, Andrew is right in the sense like the stock price is made of fundamentals as well as component that is speculative. So the question is how much, right? So at what stage are we at the moment? To be honest, I think we're in the middle of the range because, obviously there is a ceiling. Nothing can grow exponentially forever. But we'll talk about these stocks later on. Some of these chip stocks, their profit margins are insane. So Nvidia, in the mid 50s, Micron in the 60s, but that's because the memory chip stock prices are so high, and there is a supply issue, right? So, and I'll talk a little bit more about that later.
Yeah, okay, but do you think that investors are at risk in some cases of paying for optionality that will never materialize, essentially?
Absolutely. For certain segments of the market, and this is where you have to look at the fundamentals, because if a company hasn't got that crazy margin, they don't have that buffer to sustain that. So when you do have a correction in terms of that supply, these companies will get punished. Whereas some of these stronger companies, they may be able to survive that. So, it will come down at some point. It's just a matter of time.
Okay. So, Andrew, rising tide doesn't lift all boats. So if you're talking US in particular, do you have to go outside of those sort of platform monopolies to find real value?
I think you can find some value in them as well, depends on which one, and we'll talk about some of them today. But I think in general, if you are playing in the same place as every other person in the market, and the hottest trade right now is US mega caps and US semiconductors, then unless you personally have some incredibly deep insight, whether that's access to information that others don't have, or personal circumstance and knowledge that others don't have, what makes you think that you will be on the right side of that trade? If you think of it like an auction, right? Going to a house auction. If you're the only bidder, or the only bidder who knows how you can do something with that house, then winning an auction ends up in your favour. You end up getting a wonderful asset at a reasonable price, well below what you can make it worth. But if you turn up to an auction like on the block, and there are 300 other bidders, half of whom are capital unconstrained because they're there in the case of in the block because they want their face on TV. In the case of in the market, we'd call that passive investors who are tracking an index. They don't care what price they pay, they just have to own it at a certain percentage. Then almost certainly winning that auction is going to blow up your money. It's just a question of when does it blow up your money. Does it blow up your money today, in a week's time, in 6 months' time, in 6 years' time when the house has problems because unlicensed builders did half the work? And that's the challenge that value investors have in the market when you look at the crowded trades. You have to ask yourself the question, what do you know? And I would say in Australia, what do you know sitting in Sydney, Melbourne, Brisbane, Perth, Adelaide, that Silicon Valley doesn't know, being right there? Because if they're selling and you're buying, they're not selling it to you because they think you're getting the right end of that deal.
Yeah, so what do you say to all of that?
Yeah, so I guess it's the other side of the argument where it's the demand-focused side, right? So again, taking the property example, if you're an auction, I mean, if you bought it earlier on the housing market or even midway like 10 years ago, right, you still doubled your money, right? So there's opportunity still there, but it's really how you risk manage, because I'm not saying that, prices don't correct over time, and they do eventually tend towards fundamental value, right? So the question is actually like, when the stocks have momentum, you can still play these stocks, but you've got to be aware that these stocks are expensive, and you've got to be managing the risk very well.
Where do you see traditional sort of value sitting when we're talking about hyperscalers and mega caps and mags, all of that sort of really emotive language around that?
It's really interesting because when I look at this whole tech and AI space, I break it into 3 layers. So you've got the infrastructure layers where, for example, you're talking about data centers, you're talking about the hardware components like RAM, GPUs, all that stuff. You've got the cloud service, which goes above that, which gives the ability for people to use that base infrastructure, and then you've got the application level above, right? So most of the money at the moment is going into the infrastructure, and it makes sense because people got to build that compute capacity to actually service all the applications that they make. Cloud also at the same time has benefited in some form, as we see with AWS and Google's growth in their cloud service. But I think the application layer hasn't really experienced that. And, it could be the case that, these companies haven't really figured out the end use case for AI in an elegant way. Just like in the internet age, where early on in the early 2000s, we didn't have Facebook yet. So it might be another couple of years where, a revolutionary app or something comes out and it utilizes AI. So I think, and on the infrastructure side, it is probably mid to late cycle already. A lot of the spend capex has been happening. The cloud service, I think, still has a lot more ability to scale. And then, the application layer, it's still a bit of an uncertainty.
Okay. I will give you this question to think about while I talk to Andrew. So do you guys at MPC have some sort of a checklist which you would go through to determine whether there's still value left in a stock or what you would think about before you'd be willing to pay up for that momentum? Pause. Yeah. Andrew, I would assume when you're looking at these US companies, because I don't talk to you about global companies very often, if at all, you're still looking for earning stability, you're still looking for cash flow. Like,
absolutely. I mean, we've covered the US as a company since we started. So we cover 52 global markets, actually. The majority of what we talk about together here, of course, is Australian focused because that's AusBiz's core business and that's what we're here for. But about half of our fund money is deployed in the US and Europe. About half of our personal money tends to be as well if you look across our membership base. And we've been running, deep dives on US and European companies for since 2001 we've been tracking it. And the really interesting thing about that is in the period from sort of 2001 till about last year, the Australian market outperformed the US for that 24-year period. It's in the last year that the US has got sexy in comparison returns-wise, because it's had all this sudden gain in the last year. So now we're talking about the US market. But, the fundamentals that make an investment a good investment, let's not talk business fundamentals, just economic investing fundamentals, are the same no matter where the company is domiciled. It's, is this business profitable? Does it have an economic moat, a barrier to entry or an ability to extract value, a competitive advantage? Are the risks understandable and reasonable? Are the stewards of your capital acting with your interests in mind? In other words, they're not doing a form of corruption to extract more value for themselves from you. And then lastly, can you buy that asset at a reasonable price? And I think the fascinating question right now is the US market at a reasonable price compared to other places you could be putting your capital? And I would argue 4 or 5 years ago, and we were covering NVIDIA 4 or 5 years ago, Kai and I were talking about that before, NVIDIA met all of those criteria. Does NVIDIA meet that today, now that it is the highest market cap company in the world?
So, what do you look for?
Yeah, well, obviously we take the fundamentals into consideration as well, but you really got to look at the business, especially if you're considering for long term. Do they have a moat where, say a lot of these chips, like let's take NVIDIA or SK Hynix or Micron, they do have a monopoly in that space. So, right, SK Hynix and Samsung has about 70% of the Korean share market, or even in chip stocks, right? So, in terms of producing these HBMs, which is high bandwidth memory, they're the only couple of companies in the world that can produce it. So you do have a supply side constraint, and they do have a competitive advantage, right? So, and some of these companies, the margins are crazy. So at the prices at which the products are selling, because the demand is there, it justifies the price, in my opinion, right? I don't know if that raw price can be sustained over the long term, but as where it is now, it is incredibly profitable.
And that's because of the moat.
Yes.
So moats are important to you. Price paid is still important to you?
Absolutely.
Yeah. All right. Well, look, we could continue to talk, but let's look at this in practicality. Let's go head to head. So, to investors, one question. Is there any value in US tech right now? Or are investors setting themselves up for a value trap? Let's go head to head, look at some of the most valuable companies in the US with Andrew Coleman from Team Invest and Kai Chen from MPC Markets, still here with me in studio. Okay, so where are we going to start? I believe we are starting with Apple. View on Apple, because last week was pretty interesting in Apple saying that it was actually going to be rising or lifting the prices of MacBooks, of iPads, iPhones, to cover the cost, rising cost of components. They've basically said, we can't cover this anymore for you consumers. How big a deal is that?
Oh, I think Apple's overpriced in terms of their products as well as stock.
Okay.
To put it out there, I think back when Jobs was around then, obviously this is about 10 years ago, there was a real reason why people switched to the Apple ecosystem, because, they produced great phones, it was revolutionary, but at the moment it's just basic upgrades, and, there's nothing really innovative to come out. And basically in that AI race, I know they're bringing on their own Apple Intelligence platform, but, they are really actually behind in that race in terms of keeping up. But I guess on the positive side, there are some pluses for Apple. They have such a big distribution network, and some of the other companies will kill for that distribution network, right? So imagine if OpenAI or Anthropic had that platform to actually launch it on their OS. So they do have an advantage, but I think they just haven't really captured it. In terms of where it's priced at the moment, it's at a 34 PE. It's fairly high. I wouldn't say it's cheap at all. But it's really the growth potential in that tech sector for Apple where I'm concerned about. I wouldn't be really investing into Apple.
Oh, wow. Okay, so that's pretty definitive.
Yeah.
Do you have a view on Apple from the conscious investor?
Yeah, so, we've been invested in Apple in our fund for probably a decade now. Wonderful company that has very strong moats. And to your point, Kai, I agree that innovation has declined a little bit since Steve Jobs left. I mean, he was obviously core to that. But if we just pull up the chart, this is the chart of its earnings and sales over the last sort of 10 years. And what we can see from that is that earnings have continued to rise at about 15% per annum with a very high degree of stability. I mean, you can see that in the chart, and so have sales. Now, the interesting question with Apple at the moment is they've taken a very different strategic position to the other hyperscalers, whatever we want to sort of fancy Mag 7 call them. We get a different name every week in the press, right? But what they've said is look, we don't want to invest in building AI models and building AI data centers. What we're going to be is a user of those. So we're going to see whose models are best, and then we're going to wrap them into our Apple products and effectively share the margin with you by, wrapping that through to the customer. Now that, of course, is a really interesting position because it's the very opposite of what all of the others are doing. All of the others are investing huge amounts of capital to try and win the race. For those of you with a business background at home, of course, you will realize that there are two very fundamentally different strategies therefore at play. To a Google, to a Microsoft, to a Tesla, Grok X, whichever one is under SpaceX now, isn't it? Wherever that's sitting, they have to win that race, and they have to win it with a huge amount of capital at risk. So these are very binary outcomes. Either invest lots of money and it comes off and return, hopefully, a reasonable return on capital, or get it wrong and blow up shareholders' wealth. And Apple has said, no, you don't understand our business. Our business is not a tech business, a coding business. Our business is a consumer products business. Our job is to have customers who love our brand and our product, who are prepared to pay through the nose. I'm clearly not using an Apple, so you can understand which side of the fence I sit on there. But who are prepared to pay through the nose because of the ecosystem we provide and the experience we provide. Therefore, we don't need to own the model. We just need to give someone the ability to use the right model for their application. And that is a much, much lower capital intensity of a business. It gives you much greater flexibility. But of course, if it turns out that one player wins all, it won't be Apple. And that's the interesting thing as an investor going forward. So we continue to hold Apple on the basis that we like that optionality and that low capital intensity. And Apple's sitting on all this cash, they can wait and see who wins and then play. But for a while there, we seem to be the only people thinking that, and we were able to buy Apple cheap. That is not the case anymore. Kai's right, it's on a PE at 34 times now, and I think any time a company's PE is north of 30, as a value investor, it starts to get hard to justify.
Got it. All right. I think I put us slightly out of order, so my apologies, guys. But let's get to NVIDIA, and I'll start with you, Kai, because you've mentioned NVIDIA and just the, amazing market-leading position that it's in. But again, it does keep shooting the lights out. Does the share price appreciation after those results continue to come through to the same extent because it's already priced so high?
Yeah, so I'll explain a little bit about the moat. So going back into why it has a competitive advantage, right? It's actually not the hardware. Right, so I think a lot of people think that it's actually the GPU or whatever it is that they have the moat in. It's not the GPU, right? Because AMD actually they can produce comparable hardware to what NVIDIA does. It's actually the CUDA moat. So basically, it's all the networking, all the coding to the hardware. That is what all these AI developers are using at the moment. The whole infrastructure is built around that. In order to shift from NVIDIA into AMD, it's an incredibly difficult task. And that's about a 5 to 10 year transition for a company where the whole infrastructure is built to another system. And that's really the core challenge of it. And that's why they have such a big moat, right? And, that really shows because, basically they've had incredible growth. Their Blackwell GPUs have sold incredibly well, it's sold out. And they are looking to release their next platform later this year. So let's talk about the profit margin now. So is it too expensive? And at where the prices are for GPUs now, it is not, right? Okay. At a 55% margin, that is incredible. Like if you think about any business that's making half in net profit, that's incredible. So, and it's always beating expectations. So, is it cheap? Probably not, but I think it's actually roughly about fairly priced. Now, the question on risk is where, will this, with GPUs being so expensive, are we going to get challenges? Google's got their own TPUs. It's another, it's obviously different to GPUs, but they have their own stack. Can AMD actually come and displace it? Will they go for a cheaper model? And AMD's done that before with Intel, right? So AMD CPUs have historically been very cheap, but now they're far ahead in terms of Intel, right? So they can have a really good strategy and model to really take over the leading. But I think it's going to take a bit of time. It's not going to displace anytime soon.
So NVIDIA, it's actually not, I mean, in the past 6 months, it's only up about 5%. So you reckon you could still buy NVIDIA?
I think it's fairly priced. I think their margins justify the price. It's a speculation in terms of whether a competitor will come in and try to take it.
So NVIDIA, I mean, arguably, it is cheaper than it has been at this time. But you would have preferred to get in about 5 years ago, no?
Yeah, well, we started covering NVIDIA in 2022. And the reason we started covering NVIDIA in 2022, amusingly, was two things. Number one, like many of our generation, I was a gamer growing up, and so I used to build computers with NVIDIA GPUs in them. That's a whole other story. But the main reason we started covering it actually is we had a private equity investment. We still have a private equity investment that happens to be one of NVIDIA's two suppliers in this country. So if you buy an NVIDIA chip in Australia, you are very thankfully contributing to our bottom line at Tip Group, the head company. But as a result, we could see the volumes that were starting to move. And that gave us the question of, well, what's going on here? Now, originally that was amusingly with Bitcoin mining, and it then moved into AI, but that was when we started to cover it. I think there's an important thing, though, when we talk about NVIDIA to separate, which is NVIDIA is right now the most valuable in terms of market cap company in the world for one simple reason, which is that is the growth of its earnings and sales per share. And that is not just unheard of, that is so far outside the realms of anything that I've ever seen before and most people in the market have seen before, that it is letting people suspend disbelief. Now, what do I mean by that? That's 100% per year growth, more than 100% per year growth with a high degree of stability. And it's coming rarely in the one thing that businesses almost never do, which is despite growing at that kind of rate, its margin, this is its net profit margin, is increasing. Now, NVIDIA used to dominate its space, so this is not a new monopoly that is suddenly invented. And yet, despite already dominating the niche, despite growing sales that much, it's been able to increase margins, effectively double them over 4 or 5 years. That says two things. Number one, if you extrapolate out that growth and that margin for the next 5 or 10 years, NVIDIA is cheap at almost any price. Because the mathematics of compounding a number that fast for that long mean that it's basically bigger than the world. So at that point, it doesn't matter what you pay for NVIDIA. But a little bit of common sense then makes you ask from a business point of view, how long can they sustain such a big growth rate and such a big margin prize now that others have woken up to the space? Now, 5 years ago, no one else was trying to make GPUs in this kind of way because it was a tiny little market for niche uses. Now it is the most contested in terms of new startups in hardware space in the world. If you believe that NVIDIA can maintain that position, NVIDIA's cheap at any price. If you take my view, which is that competition has tended to make a fool out of wonderful technology more often than not over history, then I think you have to put NVIDIA in the too hard basket right now, which is not to say it's not an incredibly wonderful company or that it looks cheaper than it was a year ago on a relative value basis, but it's how can you be virtually certain about what NVIDIA's performance will be 5 or 10 years from now when we don't know what the demand of its customers to be able to afford it 5 or 10 years from now is. We don't know what competition looks like, and there are so many circular deals going on, you don't know who's going to be able to pay the bills.
Okay, but you'll hold NVIDIA.
No, we've sold.
Oh, you've sold.
Because it's too high.
You can
and there's a better use of
call
capital.
that take some profits as well.
If you want to put it that way.
So economic historian and PC assembler or computer scientist.
A very bad one, not very good at it.
I learn something new every day.
and I would say very quickly started buying from other people because I realized putting them together myself, I was making more errors.
So we don't have any story from the dad's garage coming through today. All right. Let's move on to Alphabet, the Google parent company, of course. I like how we're going here. So Kai, your view on Alphabet and its relative value right now.
Yeah, I mean, I think Google is the pick for me. And the reason why is, one, obviously on a PE ratio, it's a little bit cheaper than the rest. But also, like, if you think about the technology stack, Google is really, really complete, right? So across that whole entire spectrum, they've got the TPUs are created by Google. So they tensor processing units, like that's what they make, right? So they have a competing products in that GPU space with NVIDIA. They don't need NVIDIA hardware, right? So, and then the next level was basically, their cloud service. This is growing at a really, really fast rate. AWS is still the largest in that space, but Google has competitive advantage because as you scale, you have control of the hardware. You can actually scale for cheaper costs and deliver better service as well. And then at the top, application level, obviously Google's very competitive. I think the big question mark is, the core business model, which is search. I do think they need to change their business model and modernize it because there's a lot of competition, and there was an antitrust, the DOJ, I think there was a case where they wanted to split off Chrome, which is, very sticky for them. And Perplexity is up a new challenger to Google because, the way, just think about your workflow now, like I would say half the time I go on Google and search for the things, but for more complex question, I'm going to Perplexity or Claude or whatever it is, right? So I think there is still a space for search, but it needs to evolve. And I don't think it's implementation right now where they're using Gemini to go, here's a quick summary.
No, especially because they're just sort of stealing content from elsewhere.
Yeah.
I mean, the content has to come from someplace. So presumably Google, Perplexity, whoever is going to have to pay for content at some point. But I've just put my media executive hat on. I'm kidding. So Google's the pick of the bunch for you. Talk to us about Alphabet.
Yeah, I mean, wonderful company again. Growth rate sort of 25% per annum with an incredibly high degree of stability for 20 years now. Very high return on equity, return on capital, though that may come down if they start to spend the kind of capex that potentially it looks like they may want to start spending. That's my big concern with Google is at what point if they start going into the capex game, do they start to wreck the core capital light successful business model. Having said that, it's the biggest holding in our fund from our US holdings and in fact in dollar terms even of our Australian holdings because we've got less US stocks and therefore individual positions are larger. But we have started to take, in your words, I hate it, a little bit off the table, take a little bit of profits, mainly because we bought a couple of years ago when everyone started getting scared that Google's search would be destroyed, and we took one look at the numbers and everything we were using and saying that doesn't make sense as a thesis. So, it's coming up to tax time. What I would say with Google, to your point there, is the market has and people in the market have this incredible propensity to decide they love something one year, hate it the next, and go back to loving it only a year or two later. And Google is a great example of just that sentiment driven, right? Wasn't it? Because 5 years ago, Google was amazing. Everyone loved Google. And then we got a series of news stories around antitrust and AI and all sorts of other things that effectively meant Google went out of favour and you could buy Google on a teens PE. We're talking 15, 16 times earnings. For a company growing at that kind of rate with a dominant market position, I mean, I may not be a fan of how they've used some of that dominant market position, to your point around, theft of IP, particularly around media, but you cannot steal IP in media if you don't have a dominant market position. Otherwise, you'd have had to pay for it. So in a way, those antitrust legislations and lawsuits are proof of the moats that Google has. And yet the market took that news as we should assume Google won't grow. So there was a time there, I think, where you really could buy Google cheap. We certainly loaded up on it. I don't think that's the time right now. Maybe if it drops a bit, it will be. But again, these are wonderful companies. We're looking here at some of the biggest companies in the world, and they're the biggest companies in the world in all but one case because they make the most profit in the world. Google is the most profitable company in the world. Nvidia is number 2. As a result, they're going to look wonderful from a value lens, provided you can buy them at the right price. That's the only comment I have on these, is now the right price.
Okay. Let's get to Amazon. So we've been told for so many years Amazon is not the retail seller. Amazon is AWS. How is Amazon, in your view, stacking up when it comes to this whole AI spend story?
Yeah, no, it's incredible. Yeah, no, exactly right. I think for people who still think Amazon is a retail space, that is not the core of their business. In fact, in terms of profitability, their AWS service is much more profitable. And, they are, to the question, are they spending? They're spending about $200 billion in terms of CapEx.
Oh, just $200 billion.
$200 billion.
I mean, it's crazy.
Fun fact, actually, I was looking at the CapEx before in terms of all these cloud services. Last year they spent about the same as the Australian budget.
Yeah.
Right. So incredible spend. But to justify that, they actually do have a backlog of subscription, right? So when you purchase these subscriptions, it's already been invoiced, right? So they're not spending money that they don't have uncertainty that's coming in. So that's one thing to justify that. In terms of their scalability, again, it's the top of the game in terms of cloud service. Incredibly high margin, and obviously with scale, there's more efficiencies to come. So they are the leaders in the pack in terms of cloud service. So I'm pretty positive in terms of Amazon. I don't think it's cheap. I'd say they're relatively around the same league as Google. In terms of valuations. It's not cheap, it's not expensive, not as overpriced as some of the chip stocks. It's somewhere in the middle.
Yeah, okay. Yeah. So Andrew, through a value lens.
Yeah, wonderful company, again, one that's been in our fund for a very long time. I think the interesting comment to your point there around 200 billion, it sounds like a small number because some of these other companies are throwing around trillions of dollars and the market cap of these companies are so huge. I've just brought up the chart though. This is the earnings and sales of Amazon, not on a per share basis like we normally show them, but in actual dollars, in billions of dollars on the scale. And Amazon made roughly 80 billion last year, you can see when I hover the cursor over, which means this current year's CapEx bill is 3 times their record profit. Now, if you take out the AI message here, where everyone's sort of really bullish, and you just said, I've got a retailer or manufacturer or service provider, any industry, and I'm about to spend 3 years of profit in one go on CapEx that I hope will return, and that's not going to be all my CapEx, that's going to be the beginnings of my CapEx, because they've indicated they're going to do that for multiple years at a time, you'd start to be asking the question, what about debt? How are they going to fund this? And I think that's the question that Amazon is going to have to deal with, because Amazon, with all its existing debt already, it's got big warehouses, big logistics hubs, I think Amazon is going to potentially pretty quickly trip up our filters on debt to equity. It's got about 42% debt to equity currently. So you throw 200 billion of new debt on, it probably goes above our requirement at 70. That's not a problem we've had to deal with yet, but it's something that I think a value investor is going to have to deal with in the future. That's on a per share basis, the earnings and sales.
Okay.
As a result, I'm going to put it as a hold, as I've done for almost all the others. Again, wonderful company, incredible moats, incredible market position, but do you want to be paying premium prices when you're uncertain about the future? A value investor, a team investor would say no.
Yeah, I'm sensing a theme here with these big tech stocks in the States. So look, let's wrap it up with Micron. So I'm going to start with you, Kai, again, but we have fresh information to go on from Micron last week. There's a lot of hesitation in markets waiting for it to report. In fact, the share price on the day was lower and then soared in after hours when this blockbuster result came through. I've had people call it stunning, all the adjectives you want to throw in. How about Microsoft's valuation?
Oh, Micron, yeah. So
Micron, sorry.
Yeah, no. When you look at these memory chip stocks, it is mind-boggling because if you have an exponential chart, it just keeps going. And the momentum is there. So, but there's a fundamental reason behind this. And when they release the earnings, the margin is 60%. And the story I keep telling is I do a lot with computers as well. I build servers and stuff like that. So
oh my gosh,
he's well beyond me.
Here.
Well beyond me.
And the other day, I was really interesting because I was like, okay, we need to get more memory on this computer, right? And I'm going on eBay or whatever sites. I'm going, okay, well, I've got to buy memory sticks. To buy the memory sticks, it was more expensive than buying an older server with the same specs.
Oh wow!
It's crazy. So the price is definitely there to justify that, and that's why they're getting the 60% margin. And to go into a little bit more of the technical component of it, there's 3 people that produce HBMs. It's high bandwidth memory. These are the things that you stick onto the GPUs to provide the memories for the GPUs, right? And basically, it's SK Hynix, Samsung, and Micron. So they control the market in that sense. But there's also a bottleneck in terms of with TSM. In order to glue it on, you need to package it with TSM. So there is a supply constraint. This is a story of supply constraint. If that resolves, I do not think the price of Micron or any of these chip stocks should be here, right? But it really is a question of how long it's going to take to resolve. So if it stays here for another couple of years, the price is completely justified, right? People are willing to pay that price. There's demand coming through with all the data centers being built in GPUs. All I'm saying is it's supply.
Yeah.
Yeah.
So through a value investing lens, Micron.
Yeah, it's certainly the weakest by far of the companies we've spoken about. If we just want to pull the chart up, the interesting thing about Micron, and you touched on it before there, Kai, it's in a competitive space. There are two other very large players, and historically it was a space that for all three of those players was relatively low margin. You know, memory sticks and others, they've got a price to them, but they weren't the sexy componentry that businesses, let alone nerds like, sounds like you and I both were, you definitely better than me at it, but we were prepared to pay, right? And then suddenly overnight, because of this bottleneck, have a look at what's happened to Micron's earnings. Effectively, this is a business that was oscillating around anemic returns of equity and returns on capital and profits. I mean, that's a negative profit in 23, tiny little profits in the years before, has shot the lights out to the point where that final bar on the far right-hand side looks like it's from the wrong company. And it almost looks like we've transposed someone else onto Micron's chart. The question you therefore have to have if you're a value investor, a Buffett-style team investor is that one-off a flash in the pan, or is it something that's going to be repeated? It's a new normal. We would say history is your best friend for understanding that. And most companies that are in a space where suddenly their product becomes scarce and their margins increase, they aren't able to maintain those margins for very long. Not because they're not a wonderful business, but because the same competitive dynamic that meant margins were small in the past hasn't shifted. We've had a demand lift, if you think of it in an economics point of view. The demand curve has shifted upwards, but there aren't suddenly new moats. There's not suddenly new barriers to entry with legislation or capital expenditure or something. So the same dynamics that means all three, Samsung, SK Hynix and Micron, have got a sudden boost to margins. And it is a sudden boost. I mean, that's insanity, right? Like incredible, right? Spectacular. If you happen to be on the right side of that, you've done very well. But I don't think those are industry dynamics that will stay for very long. So we would avoid.
Yeah, I think it's a question of timing. Again, I don't think there's, from a technical perspective, why someone else couldn't come in and do that. It's just at the moment there's no capacity, and again, it's TSM that's constrained there, right? So
yeah, and it was boring. I mean, like 5 years ago, if you were trying to raise money to build a memory company, you wouldn't have got any tech backers. They would have looked at you like you were nuts. This is old technology. It's boring. It's a commodity. You can buy them in USB sticks. You can plug them in at, they were $3-4 per 100 gigs at one point, right? Now we're talking orders of magnitude, right? So from that point of view, they're in the right place at the right time. But can that right place sustain itself? And can you as a value investor have the virtual certainty about that means you're happy to put your money there and come back in 5 or 10 years' time and see it materially larger? That's the question.
Yeah, I certainly don't think it's going to last like 5 to 10 years, because there's enough money in this where this competitor comes and looks at it going, Jesus, like there's people are paying a lot for these memory sticks, right? So it's definitely incentive to come in. I think it's just when can they ramp up production?
Well, I would almost like to take myself out of this conversation and just let you guys go, because you're on the same plane. We've got an economic historian, PC assembler, we've got and CEO, we've got a trader, we've got a computer scientist, borderline, and AI innovator.
We do a regular coffee in Gordon, by the way. You're welcome to join.
I'm your host, Nadine Blaney. Anyways, Kai Chen, MPC Markets, welcome back anytime. Thank you so much. And Andrew's going to stick around and answer your question. So let's answer a viewer question because you asked. Of course, you can too ask the team a question. Just email us at wealthy@ausbiz.com.au. And today's question comes from Jan, who asks, what is Team Invest's view of REITs? And do you have a favorite? Well, this is an interesting one, and I dare say Jen has asked because REITs have sort of been surfacing in broker calls and in the news a little bit more lately because we're talking about sort of peak rates. Do you like REITs?
No. But I don't like REITs not because of necessarily a reason we can't discuss. So to me, there are two big problems with REITs for us and our members. The first is a personal one, which is that the odds are if you're a pretty wealthy Australian, and the majority of our members are self-made wealth, but they're wealthy, that's why they do what we do, they have money to invest, and I assume most people on watching the show will fall into that category. You probably already have a very large amount of property in your net wealth, because having been an Australian and having bought a home and maybe an investment property and the compounding nature of that over the last 40 years, you've ended up with quite a large property exposure. So the question I would always ask is, why do you want to now go and increase your property exposure indirectly through someone else? If you've got all the skill of identifying property yourself, most Australians do, and you're perfectly comfortable owning property in your own name, what's the attraction of buying a share that's listed on the stock market that has other people go out and buy the same property you could buy. So that's the most fundamental reason. The second thing, though, is that it's an incredibly competitive space. You know, we were talking before about moats and risks. What moat does any REIT have over another REIT? It's pretty limited, right? Property is relatively easy to buy in this country. We thankfully don't have the levels of corruption that says only certain people can own certain assets. So all assets are up for sale pretty much all the time in the property market. And the winner tends to be the one who either sees the most potential upside or has the biggest checkbook. As a result, there are very few barriers to entry or competitive advantages that any REIT can have beyond having simply bought well in the past. And if all you're doing is buying well in the past, well, markets are pretty good at identifying that. You know, we can look through, see what they are, and therefore the potential return you can get tends to not be much better than, you know, the rental yield on your own property. So as a result, it's not going to give you the 15 or 20% return per annum that we would want. It's not going to give you the level of virtual certainty around result because there's no barriers to entry, no moats, and you've already got exposure yourself. So from that point of view, we tend not to spend much time.
Got it. Thank you. All right, Andrew, thanks for joining us as always from Team Invest. I enjoyed that program. I always say that, I think. If you would like to ask a question of the team, email wealthy@ausbiz.com.au. Thanks for watching. We'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Team Invest.